Okay, EPS IAS 33 earning per share, very interesting and very important standard. Of course, we are going to learn in this chapter how to calculate EPS. EPS has implications in interpretation of your financial information. It also has quite a lot of implication in your financial management when you are making investment decisions. So EPS actually stands for earnings per share, which means that what are the, if I speak it starting from the very basics, that what are the net earnings and what are these net earnings I'm going to discuss divided by the number of shares. So this is actually the basic concept. Of course, there are some complications, and those complications will be discussed. So if you speak like that the company has, let's suppose, net earnings of 2 million, and the company has 1 million shares. So you say that $2 per share is EPS. So $2 per share, which means that each share is getting earnings of $2. Now remember that these are earnings, not dividends. Dividends might be given as, I don't know, maybe $0.5 per share. Shareholders, they decide that we are going to give 50 cents as dividend. Earnings are $2. Dividends are, 50 cents. So $1.5 that remains or that goes into the retained earnings. So whatever you give dividend, that's a different case. Whatever are the retained earnings, it's a different case. But we always are concerned about how much each share is earning and what are the earnings allocated to every share. So if I have, for example, 100,000 shares, I know that 100,000 shares times 2, $200,000 is my earning. And management will never take a decision in business which will bring down the EPS. So every time when you are taking any new investment decision, financing decision, you are considering what is going to be the impact on EPS. Is EPS going up or no? So EPS is one very critical, factor in understanding a business performance. So we always are concerned in, making the share price go up and making the EPS go up. So let's see something. The topic list, which we have basic EPS, and then you have diluted EPS. These are the two types of EPS we learn how to calculate. Then effects on EPS of changes in capital structure, we are going to discuss. And there are some other like effect of bonus issues, right issues on EPS. So syllabus learning outcomes, calculate EPS in accordance with relevant accounting standard dealing with bonus issues, full market value issues. These full market value issues are, you can consider them as right issues, okay? Bonus issue is when you give shares, without any cash consideration. So existing shareholders, we are giving them bonus, but we don't give them bonus in form of cash. We give them bonus in form of some shares. So you just give away, free shares without any cash. Right issues, these are also the shares issued to the existing shareholders, but they are issued against cash. So full market value shares, we call them. And in both cases, you are issuing new shares, but in bonus issues, you're giving shares without any cash consideration, and right issue is, of course, against cash consideration. Full market value issues, right issues. Explain the relevance of the diluted EPS. By the way, there is a slightly different thing. I mean, right issue and full market value, there is a slight difference. And I'm going to explain this difference when a few slides later when we do some questions. There is definitely a little bit difference here in right issue and full market. Explain the relevance of the diluted EPS and calculate the diluted EPS. So basic EPS and diluted EPS, two different types. Diluted EPS is, a notional concept for future. Explain why the trend of EPS may be a more accurate indicator of a performance than a company's profit trend, and the importance of EPS as a stock market indicator. It is. I mean, if you see EPS falling down, it has a negative impact on the market price of the share. I mean, this is one of the key indicators which shareholders are always looking at. It tells you the earning capacity in relation to the number of shares. If EPS is going down, it means that your earning capacity is going down. Discuss the limitations of using EPS as a performance measure. And by the way, in many cases, we actually calculate share price based on EPS. We actually calculate many times if you want to predict the share price in future, or if you want to predict some company's share price, that how much this company's share price should have been or could have been. Let's suppose that there is a private limited company and they don't have any issued shares in the market. So of course, there is no market price of the share because shares are not bought and sold. But if you want to value this company, how do you value this company? So you would say this private limited company, if I have a public limited company, which means a listed company, this listed company has 1 million shares. This private limited company also has 1 million shares. These 1 million shares, I multiplied them with the market price, and I can assign a value to this business. This will give me business valuation. One method, like there are different methods of valuation of business. One method is market price multiplied by the number of shares, which is called market capitalization. Now, in this case of private limited company, you do have 1 million shares, but you don't have a market price. So how do we predict the market price? How do we assume a market price? We assume market price using EPS. So EPS has a great influence, a great importance in the stock market indicator, because EPS, there's a formula for calculating this price, and we are going to discuss it sometime later. But you should remember that you can calculate market price of the share, or you can assume the market price of the share using the EPS for that particular business. These are the topics we are going to discuss actually here. Basic EPS, diluted EPS, the difference between these two. EPS as a performance measure, then calculating how to calculate basic EPS, changes in equity share capital, changes in capital structure, full market, right issue, bonus issue. Then we'll talk about in order to calculate diluted EPS, you need to think about convertible debt, share options, and limitations, etc. Because we have discussed diluted 2 or 3 times, so I think I should be giving you slight explanation that what is diluted, although I'm going to cover it later slightly. What example? Like I said, that if you have earnings today, which are 2 million, and you have 1 million shares in issue, 1 million issued shares, so you can say fairly that you have $2 per share is your EPS. So this is called your basic. Diluted is moving one step forward. Moving one step forward means that sometimes the business has some potential shares. We call them potential shares. And now we have covered so much of syllabus that we already know. Potential share means, if you remember, like last lesson, we were talking about IFRS to share-based payment. We have promised some of our employees that we would give them shares. So these shares have not been issued now, but these shares will be issued sometime in future, maybe in 2 years or 3 years time. Similarly, you have some IFRS 9 convertible debt. So you have given some bonds, you have issued some bonds, and you have promised that these bonds could be redeemed in cash, or they could be converted in shares. So it means that every company has existing shares, and they also have potential shares, existing plus potential shares. Potential share means that those shares which we are under obligation, which we are under promise that we will issue sometime in future. So basic EPS you calculate using existing shares, and existing plus potential you calculate the diluted. So diluted EPS you use it by using the number, not only the existing issued shares, but also the potential ordinary shares which you already have promised. And why it is important, I tell you, because when I said that I have 2 million of earnings, and I said I have got 1 million shares, and we got an EPS of $2. $2 EPS. That looks nice. For example, for us, let's suppose it is good. Why it is good? Because our earnings are 2 million. Earnings are more. And why earnings are more? Because I told people that you work now, IFRS 2 share-based payment. I'm not going to give you cash now, but I'm going to give you equity shares in future. So we actually are postponing some of the commitments. Now, if somebody sees that there is $2 EPS, they might be very much happy that, oh, the company's EPS has gone up. Last year it was 1.5, now it is 2. So you guys are really doing good. But shareholders do not know that we also have some promise. Like they can only see that 1 million shares are on the balance sheet which have been issued, but they do not know that there are some promises as well. So diluted EPS actually, it exposes those promises which you have made. Diluted EPS takes into consideration the impact. It says that, let's suppose that these shares which we are supposed to issue after 3 years, if we had issued those shares today, if all of these shares had been issued today, how much this would have been? For example, 2 million earning. And if I had those potential shares which we have to give in 3 years time, let's suppose they are issued today. So how many there will be? You say that it is 1.3 million. So considering this number as well, now calculate how much is EPS. So we say EPS is 1.7, let's suppose. So basic would be 2 because it only includes existing shares. Diluted EPS would be 1.7, but because it includes other potentially converted shares as well. So this is the 2 types of EPS we will discuss. So far, it looks like that basic is very easy. But basic also has quite a lot of complications. We just started now. So earnings per share, EPS. EPS is a ratio which measures the amount of profits earned by a company for each ordinary share. So we call the word here earnings. We say earnings. So if you ask me the word, I would say earnings attributed to ordinary shareholders. So not preference shares, ordinary shareholders. Those earnings which are available to ordinary shareholders. And which are these earnings? Which means it is profit after tax, okay? After tax, which means that you have paid interest, you have already paid preference dividends, you already have paid your taxes. So everything has been paid out. We call it PAT, profit after tax. So taxes have been paid, preference dividend has been paid, interest has been paid. Now this is the number which is purely available for ordinary shareholder. Nobody else has a claim on that. So this earning number we will take, and then we divide it with the number of shares. And by the way, okay, let's move forward at the speed. The objective of IAS 33 was to provide a consistent method for the calculation of EPS in order to improve the comparison of the performance of different entities in the same period and of the same entity over a period. So you call it a trend analysis. Trend analysis means you compare your EPS in 2010 to 2011 and 2012 or 2021, whatever. So this is called same entity over time. When you compare your performance with your past performance, this thing is called trend analysis. So you do trend analysis here. Or what you can do, you can compare different entities, like your EPS as compared to someone else's EPS. So IAS 33 only applies to companies whose ordinary shares are publicly traded. If your shares are bought and sold in the stock market, IAS 33 applies. This is one of the differences in IFRS for SMEs, because in IFRS for SMEs, we don't calculate EPS because it does not apply for them. SMEs are not publicly traded. EPS need only be presented on the basis on consolidated results in a set of consolidated financial statements, which include the parent's separate financial statements. So consolidated results we calculate. Where the companies choose to present EPS information, even though they are not required to, they must do so in accordance with IAS 33. It means that if you are a private limited company, or if your shares are not publicly traded, you still can decide, or you still can choose that I'm going to show my EPS as well. You still can do it. But even if you are doing it, you should be using the same standard. Calculation, how do we do? The formula for EPS is the basic EPS I'm speaking about. Profit or loss for the period attributable to ordinary shareholders, which means your profit after tax, which means interest has been paid out, preference dividend has been paid out, divided by the weighted average number of ordinary shares. This is the important word, because not only the number of shares, but weighted average number of shares. Because what happens throughout the year, during the year, in the beginning, you have 1 million shares. Then here you offered, I don't know, 200,000 shares. Here you offered 300,000 shares, and end of the year you have 1 million shares. So you cannot say that I'm going to divide it with 1 million. Now, end of the year on 31st of December, total number of shares are 1.5 million. But these 1.5 million shares you did not have throughout the year. In the first 6 months, you had only 1 million. Then for the next 3 months, you have 1 million plus 0.2, which makes it 1.2 million. Then you had, again, different number of shares. Now, for a very simple calculation, how would I say? Let's suppose this is June 30th, and this is September 30th. So I'm just considering 6 month, 3 month, and 3 month period. So there are 2 or 3 ways of doing this calculation. I'll show you one way. You can use another one as well. I can say that 1 million shares, they remain for 12 months, because this 1 million you remained it for full year. Then you have this 200,000, 0.2. It remained for 6 months out of 12. So this is 12 out of 12. And then the last 0.3 is like 3 by 12. This 1 million is here and it goes until the end. So 1 million times multiplied by 12, which means multiplied by 1, because they remain for full 1 year. This 200,000 was issued on 30th of June or 1st of July. They remain for 6 months period. So 6 by 12. The last one, they only remain for 3 months period. This is one way of doing it. Another way of doing it, you can say that 1 million into 12 by 12, or let's not call it 12 by 12. I would say 1 million into 6 by 12, 1.2 million into, again, 6 by 12, this, and 1.5 million into 3 by 12. Like this. So there are different ways of calculating it. But in the end, what you need to see that how much number of shares they remain for how many months within the business. So where the profit or loss for the year for the period is consolidated profit after income tax, non-controlling interest, NCI, and preference dividend should also be taken away. You should take away that as well. The EPS calculation essentially divides the profit figure by the weighted average number of shares in issue during the period. Okay. Any change in the number of ordinary shares during the period, therefore, will impact the EPS calculation. Of course, if you issue new number of shares, there is a word which you call dilution. Okay, dilution, and that is the word coming in from for diluted EPS as well. Dilution of earnings. Dilution of earnings means that when you had your 2 million profit and you had 1 million shares, your EPS was $2. If you say that 2 million profit and I have now more share, we decide to issue more shares, so your EPS will go down, and that is what you call dilution of earnings. Earnings have been diluted. So share issues, 3 types we have. Any question until here?